Welcome to the Lauder Institute at the University of Pennsylvania. I'm Jules van Binsbergen, director of the Institute and a finance professor at the Wharton School.
And I'm Jonathan Berk, a finance professor at the Graduate School of Business at Stanford University. This is the All Else Equal podcast. Welcome back, everybody. Today we're going to talk about something called a proxy advisory firm. Jules, what is a proxy advisory firm?
These are firms that advise shareholders on what they should be voting in important shareholder meetings. And so I think that there's quite a bit of debate about what exactly they are, but let's just speculate a bit about what we think they are. I think, Jonathan, that they're essentially information aggregators who collectively take a position on particular shareholder votes, make up their mind what they think that shareholder vote should be, and then start advising large institutional investors to vote a particular way. The two biggest ones are ISS, and that stands appropriately for Institutional Shareholder Services, and the other one is Glass Lewis.
So I guess the question is, why do we need them? And the most obvious answer people give is, well, it's very costly for every single shareholder to investigate for themselves. It's more efficient if you have one person do all the investigation and then share their conclusion with shareholders. And I think that's what these firms claim to do. I mean, the problem with this is we don't really see it in other contexts. I mean, the same argument applies to political candidates, right? Nobody suggests, well, let's have a firm to tell us which political candidates to vote for. So I think we have to ask the question, first of all, what's different about proxy advisory firms? And it seems to me the crucial difference here is, what are the objectives? Why don't we go back to a topic we've often spoken about on the show, which is agreeing to disagree. So if we think about it from that perspective, if all shareholders, they should theoretically have the same objective, which is to maximize share value, why would they disagree of what votes achieve that goal? And the important observation in agreeing to disagree is they don't have to have the same information. The great insight of Aumann is, even if we don't have the same information, but if we have the same goals and we're fully rational, we can't agree to disagree. They should vote the same way. In other words, if I don't have the information and I know you do, Jules, I can look at how you're voting. So the fact that the people are not voting the same way suggests one of those assumptions is violated.
And then I think that the obvious assumption that is violated, which we also discussed in that podcast episode with Bob Aumann, is that the incentives are not aligned. People have different objectives. One thing that we often forget is that shareholders have many other interests as well. So, for example, it is quite common that firms compensate their employees with shares, which implies that many people that work at the firm are also shareholders. But if you're both working there and you're a shareholder, are your objectives going to be the same as a shareholder who's not working at the firm? And the answer is most likely not.
I agree, Jules, but that raises a real problem. I mean, it's almost a catch-22, right? If shareholders don't agree, if they have different goals, how can a proxy advisory firm help them? Because the proxy advisory firm is doing one investigation for all shareholders. So I don't understand. If shareholders have different goals, how can they advise them? They would have to do a different investigation or a different interpretation for each shareholder. And if shareholders all have the same goals, then we don't need the firm. So it seems like a catch-22. Either if shareholders are in agreement, they all have the same goal, you don't need a proxy advisory firm, you can just do what all other shareholders are doing, or they're not in agreement, in which case you might need a proxy advisory firm, but then one size doesn't fit all, so the firm can't provide much of a service.
No, I completely agree with you, Jonathan, because let's also point out one other thing, which is that if there are different interests and therefore different groups of shareholders think that a different thing is optimal, taking into account the other activities that they're also engaged in, say being employed by the firm, that means indeed that these proxy advisory firms should be given tailored advice and potentially different advice to different groups of people. But I don't think that that's what we're actually observing in the data. The joke that corporate board members make is that what does ISS think of this? As if it is one unified opinion that this firm puts out. I don't think there is this tailored advice to different shareholder groups of these proxy advisory firms where they tell them to vote different things depending on what their other interests are. So I completely agree with you.
One role that you and I have often discussed is they might just provide cover for large investors, for portfolio managers. Basically, they just can turn around to their investors and say, we just followed the advice of these firms.
And I think this last explanation is one to seriously consider, right? I think that there are a lot of decision makers that want to be able to cite somebody else to provide cover for the decision that they really want to make, so that if the decision doesn't work out, you can say, all we did was follow the advice, or all we did was follow the voting advice that these proxy advisory firms have given us.
Yeah, so Jules, we were talking about the relation between this and rating agencies, right?
Well, yeah, so bond rating agencies are another interesting case, right? So at least with bond rating agencies, I can still think of scenarios where the bond rating agencies collects information that might be new information to the market. I don't think that proxy advisory firms are really in the business of collecting through analysts additional information that provides better advice. For rating agencies, there is at least that information, although I think we also need to be realistic about the fact that if you really wanted to replicate the rating agency model with publicly available information, I don't think it's that difficult to replicate the ratings that they give out. So in that sense, I do think there's, for some reason, seems to be this demand for authoritative agencies that tell you and create a consensus around certain issues so that people can follow that. So maybe one interpretation of this is that it's a coordination device.
Yeah, I mean, it's clear that you and I, for a great deal less than Moody's spends, could probably create the ratings just using public information and get almost exactly what they get. But if we opened the Jules and Jonathan rating agency, we would lack the credibility to provide the cover. And so we wouldn't have the ability to sell those ratings. Similarly here, we have two firms, for whatever reason, have got that credibility, and it allows various investors, especially if you're small, to say, look, we are just going to follow these experts and we don't have to put any effort in ourselves. And that way we've done our due diligence and we've done what we're supposed to do. I mean, the real problem, though, is what are the true incentives of the proxy advisory firms? In a few minutes, we're going to introduce our guest, Chester Spatt. He's written this provocative new paper where he claims that one of the objectives of an advisory firm is to have a lot of close votes. Because obviously, if the vote isn't close, you don't really need an advisory firm to help you. And that because they would like to have close votes, they have an objective to create a conflict so that you can have a reason to hire the advisory firms.
Yeah, although I think that there is another side to that equation, right? I mean, if you're just creating controversy for controversy, are you not losing your reputation as an information providing agent?
Yes, absolutely. So I would argue, and we'll speak to Chester in a few minutes, that he would say this is just one of many objectives, but that it's still an objective that misaligns the investors and the agency. You know, one of the things he talks about in his papers is that maybe a better signal of how to vote would be to see how the very, very big money managers vote. So a large money manager has the economies of scale to hire their own people to do the investigation. And then based on that, they vote. So they don't use the proxy advisory firms. But I think Chester's argument is that these big money managers at least have the right incentives. But again, we've argued that not all investors are aligned. But if you, let's say you're another money manager and your incentive is to maximize the value of the shares you hold, then you're likely pretty closely aligned to these large money managers. So I think Chester might argue that instead of wasting money on a proxy advisor, just see how Vanguard votes.
Although There's always this thing where people say, oh, Vanguard has this huge returns to scale because they're large investors. And so therefore, they can hire teams of 40 people to come up with this advice. But I also think we need to realize that Vanguard is invested in several thousand stocks. And so 40 of these people that need to actively engage with the voting behavior of 4,000 stocks, compared to, say, a small mutual fund where you are only investing in 20 stocks, and therefore each stock is a much larger fraction of the portfolio that you have at stake. Don't you think that, therefore, the incentives of these small firms to engage and to vote might actually be just as large or larger than these large firms? We had a student on the market a few years ago, Felix Nocker, who made this argument quite convincingly that, small funds that have very few investments are the ones that also, say, on conference calls and earnings calls with firms are much more active because they have a much bigger incentive to engage with those firms. If you're Vanguard and a particular stock is 0.02% of your portfolio, even if it's a relatively large amount of dollar money, how does that work in the resource allocation? So there's a question here of how important are the dollar amounts versus the relative amounts. I think that is a key thing to think about.
I mean, the argument for a place like Vanguard or BlackRock is they hold such a large fraction of the shares that their vote actually counts. If we think about a small fund, it's not worth investigating because their vote doesn't count. But if you were holding 5% of the corporation, well, your vote counts. And so maybe then it's in your interest to investigate.
But Jonathan, I'm wondering whether we know how the proxy advisory firms really come to their decision. I mean, one concern that you could have is, do you think that it's possible that small funds are lobbying ISS to come up with a particular proxy advice? That at least seems a plausible possibility to me. I mean, I don't know how this works in practice, but if I were a small fund and there was this much at stake in the vote, I think I would try to contact ISS and try to convince them of my point of view.
Yeah, I mean, that's something to really think about. I don't think anybody's really thought deeply about that question. But obviously, if I am a small fund and my vote doesn't count, if I could find a coordination device with all other small funds so that we all combine in some way so that our votes do count, that would obviously be in my interests. And maybe ISS performs that role, even if it's not explicit, maybe implicitly it performs that role. And then that certainly would explain why you might pay for the service. Okay, Jules, I think it's time to introduce our guest. Chester Spatt is the Pamela R. and Kenneth B. Dunn Professor of Finance at the Tepper School of Business at Carnegie Mellon University. He also served as Chief Economist of the U.S. Securities and Exchange Commission, that's at the SEC, from 2004 to 2007. Chester, welcome to the show.
Glad to be here.
It's great to have you, Chester.
Chester, why don't we start with perhaps the most fundamental question? What services do proxy advisory firms actually provide?
They provide vote recommendations, and they assist asset management clients by providing detailed reports on issues being voted upon by the firm, as well as providing a general firm corporate governance philosophy. In some instances, in recent years, they also offer somewhat more customized advice for players with a particular orientation who want that. And I think an important point, which isn't so widely understood, is they also provide services that make it easy, or easier at least, to implement the voting decisions. For example, for the mutual funds to actually implement their votes. A lot of mutual funds view that as actually an important facet of what they get from the proxy advisory firms. All of these services reflect some degree of scale economy, which underlies why there's an important role for proxy advisory firms in the marketplace.
So now, when these proxy advisory firms give this advice, right, why is there the need for such an advice? And do you think that there's disagreement between shareholders about how they should be voting to begin with? If the objective of the management and of the equity holders is to maximize the value of the firm, should there be any disagreement at all?
Well, I think that's a very good question, and one that I've reflected on a lot. Even 50 years ago, researchers in finance studied something which was then called unanimity theory. What are the conditions for unanimity where everyone agrees to maximize firm value, which is sort of what you're referring to? And in effect, then I think some of the broad message was, well, certainly in fully complete markets, there would be unanimity. And there were some other conditions that were derived too, but there were also conditions where one didn't have unanimity. Of course, unanimity is not always the case. And from a more practical perspective, let me try to address why. First, some stockholders also work for the firm, especially executives whose effort is important and also want to diversify away from the firm, or possibly even want to allocate time to managing the rest of one's assets. There are labor unions and labor union pension funds, and they have different perspectives. And also, there's different investors in different marginal tax situations. And that's important with respect to things like dividend policy. So incentives aren't perfectly aligned. In the tax situation, for example, consider the difference between tax-exempt or tax-neutral investors on the one hand, such as typical pension plans, versus high marginal tax rate investors with respect to dividend policy. Some investors also bring their own philosophy to particular issues, probably the most visible of which is ESG in the current vernacular. As the discussion above suggests, different investors may have their own prior beliefs or bring their own assessments to the question at hand. This is why in many contexts, a voting mechanism is used to resolve the different perspectives.
Chester, but isn't this a little bit of a catch-22? I mean, either investors are in agreement to maximize share value, in which case you don't need a proxy advisory firm. They should all agree on the voting. Or they're disagreeing because they have different incentives and they're different interests, in which case, how can a proxy advisory firm help? Because they're going to be different objectives and they can't cover all the different objectives. So it seems like we have a bit of a catch-22 here.
What the proxy advisory firms can do is they can generate a lot of basic information that is relevant even for investors who go their own way. And even those investors, I think, do find it valuable. I think what the proxy advisory firms would also say is they try to put themselves in the shoes of different investors and try to provide insight from diverse perspectives to the extent that they're providing somewhat customized advice. Obviously not firm-specific advice, but from at least particular kind of perspectives.
So you would say, in that sense, they're mainly information aggregators that in some cases are willing to take the preferences of certain investor groups into account to come up with a tailored advice.
They do that to some degree. I think they've found that offering that kind of complements their core product line. Now, also keep in mind that many votes are not contested. Arguably most votes are not contested, but I think then the service that they provide is in part in identifying that a vote isn't so contested and either not so important or at least where there's not going to be disagreement. That may be a service too. And in part, from the asset manager's perspective, they're providing implementation tools that potentially make it easy to implement the votes in timely ways.
So, Chester, I think you're being a little coy here, given what I know you've written on the subject, so I'm going to be very direct then. What do you think the actual objectives of the proxy advisory firms are, and how aligned are they really with investors' objectives?
My view is that proxy advisory firms are value maximizing entities themselves. I think this is reinforced by the differences in perspective between the two major proxy advisory firms on many votes, and that major index players, such as Vanguard and to a degree BlackRock, vote in ways that are much more aligned with management than the proxy advisory firms. I think that's a very important point to understand. As my forthcoming paper in the Journal of Finance with Andrei Malenko and Nadia Malenko highlights, the proxy advisory firms have incentives to make their voting advice more valuable, which they can do by encouraging closer votes and promoting controversy by leaning against management. So I view that as an interpretation of why some of the major indexers, like Vanguard, and to a fair degree BlackRock, are much more aligned with management than the proxy advisor. Indeed, I would argue that while a lot of academics seem to view the proxy advisory firm's advice as a benchmark to evaluate mutual fund votes, my view is quite different. My view is if we need to have a benchmark, we should think of the index funds as providing a much more suitable benchmark for evaluating the votes of other mutual funds. By the way, I should also note that small mutual fund players adhere to the proxy advisory firm recommendations much more closely. They adhere to those recommendations pretty tightly. Now, why is that? Well, they lack the scale to spend so much on these votes. Some of the major players, like the Vanguards and the BlackRocks, might have staffs of perhaps 40 or so in the stewardship space. So they're like a mini proxy advisory firm, just in that space. Obviously, the scales of ISS and Glass Lewis, they're much, much bigger, of course, but nevertheless. But they're also servicing huge numbers of clients as well. The small asset managers, they lack the scale to spend like the large firms do. So you have much less independence from them. That's why I think the indexers are much more favorable to management, because they're actually doing the due diligence. And the smaller parties, they're relying on the proxy advisory firms. In effect, the small funds are free riding and utilizing more heavily the input from the proxy advisory firms. By the way, more generally, let me offer an example that illustrates that the proxy advisory firms are not always value maximizing. There was a very visible merger a couple of decades ago now between HP and Compact, and it was very controversial. Well, ISS recommended to the HP shareholders to vote for the merger with Compact, even though whenever there were signals that there was more support for the merger, the HP stock price was declining. Clearly, ISS ignored those signals. Those signals were before the recommendation, just to be clear. It wasn't simply that the market reacted. The market did react to the ISS recommendation. But even before the recommendation, when there were other signals about the likelihood of the deal going through, it was clear to neutral observers that it was a bad deal from the point of view of the HP stockholders. But what did ISS recommend? They recommended for the merger. The deal went through just barely with less than 52% support. I think most observers think that probably pivoted the deal.
Since that merger, everybody agrees it was a total disaster, right?
Absolutely. I think this clearly illustrates a failure of value maximization in the ISS recommendation.
Chester, let me summarize what I think you're saying, which is the following. You're saying the Compact HP merger is an illustration of something where the fact that they made the vote close increased controversy and therefore increased the value of their services. And that's one of their objectives, to increase the value of their services. On the other hand, BlackRock, or one of the big mutual funds, when they do the same investigation, their objectives are much more narrowly only on the value of the company and what's good for the company. And so your feeling is that is a better benchmark because the objectives of those organizations are better aligned.
That's essentially what I'm saying. I wouldn't want to say that there are no conflicts present, even with a big indexer. They may have some conflicts too, but I think their incentives are much better aligned. And indeed, there is some small difference. The votes of BlackRock and of Vanguard, they're not exactly aligned, but they're much closer and very different than the recommendations of ISS.
Although, let's be clear, in this case, there was a real cost for ISS as well for having recommended what they did. Because obviously, after things have gone south, if that happens too often, there's some cost to this strategy as well.
Absolutely. You're raising a very important point, because people might take their recommendations less seriously. That's the cost. And therefore, from that perspective, possibly reduce the value of their services.
Well, Chester, thank you so much for being on the show. It was a real pleasure to have you. Those were some great insights.
Thanks.
Thanks for listening to the All Else Equal podcast. Please leave us a review at Apple Podcasts. We love to hear from our listeners. Also, be sure to catch our next episode by subscribing or following our show wherever you listen to your podcasts. For more information and episodes, visit allelseequalpodcast.com or follow us on LinkedIn. The All Else Equal podcast is a joint production of Stanford University's Graduate School of Business and the Lauder Institute at the University of Pennsylvania. It is produced by University FM.